Hey, welcome back, guys. It's Dan from Pekoe.ca. Did you know that reducing your amortization will effectively decrease the amount you can borrow from the bank? That's right. Today we're talking about amortization and what that does, what that means, and a few ways that you can reduce the amount of interest you're paying on your mortgage to effectively pay it down quicker. All right, so let's jump into it. What is amortization? Amortization is simply the process of paying down debt by making regular payments. So, in the terms of a mortgage, you'll have an amortization schedule once you've got a mortgage that'll kind of break down every month or weekly or bi-weekly those payments for the duration of the term, and then effectively the overall payback of that mortgage. Typically in Canada, we're seeing 25 years as a maximum for insured mortgages, 30 years, or even 35 years for uninsured or conventional mortgages. So I want to talk about that a little bit and explain why it might not be your best strategy to just right off the bat say, hey, I want to lower amortization because I don't want to pay my mortgage back in 25 years. I actually want to pay it back in maybe 15 years. So let's look at those numbers and see what that does to your overall affordability. Okay, guys, no need to get your calculator out. I've already done the calculations here. And what I'm going to do is run through some of the assumptions. So we're assuming a single family detached home, household income of $100,000, and assume that we're purchasing. So with 5% down, that's an insured mortgage. We've got to include the mortgage insurance when we're calculating your debt ratios. And what happens is if you're requesting a 15-year amortization, the stress test is also tested on a 15-year amortization. What does that do? Well, that effectively increases your monthly payments and restricts your cash flow because all of a sudden, let's say we have a $500,000 house you want to buy with 5% down, that mortgage now has to be paid back in 15 years as opposed to 25 years. When we're looking at those numbers, a $500,000 mortgage with 5% down is your maximum on a 25-year amortization. But if we reduce that amortization to only 15 years, we are now exceeding your debt ratios, which means we have to reduce the amount of mortgage. And effectively, it reduces your purchasing power down to $375,000 with 5% down. That works out to a 25% drop in your purchasing power. So you're no longer looking for properties at 500,000, you're looking at 375,000. So you're thinking, well, what can I do in order to pay back that mortgage quicker? I've got a couple strategies we can look at in order to do that, and I'm going to jump into those right now. Option number one. Every mortgage has prepayment privileges. Well, most do. And you want to shop around for a mortgage that has very generous prepayment privileges, meaning they allow you to make lump sum payments. Lump sum payments are simply a payment that's either applied once a year on the anniversary, or you can make these lump sum payments throughout the year. Banks vary. They can go as little as 10% up to 20%. But you can capitalize on putting a lump sum payment down, and that'll directly hit the principal of your mortgage, and that'll effectively shave up to years off of your payment term. I've seen a lot of Canadians too waiting until tax return season and using their tax returns to put it directly on the mortgage. So that's one strategy you can look at. The other one is increasing your payments. So every, let's say, month, increasing your mortgage payment will go towards your principal and pay down that mortgage quicker. The third option we can look at is taking your monthly payments, which are 12 payments a year, and shifting it over to a biweekly accelerated. So biweekly would be 52 divided into 2, so 26 payments a year. You're effectively making one extra monthly payment for that year. And that works out to thousands of dollars saved in interest over the term. And you're reducing that amortization again by years if you keep that up. So those are three strategies, guys, you can look at. I strongly recommend going with the maximum amortization you're allowed. So on insured mortgages, that caps at 25 years. Keep in mind, if you are refinancing your home and you reduce that amortization, that's also going to reduce the amount you can access from your house. So that's what I've got today, guys. What are some of those strategies you're using in order to pay down your mortgage quicker? I'd love to hear your comments below. And if you haven't already, please subscribe, like this video, share it with your friends. Okay, hope you're having a great day.